One of the things every investor wants to hear about in your pitch is your total market opportunity. How big can your company plausibly get? And they're expecting you to talk about the TAM, SAM, and SOM for your marketplace. So you need to understand what those acronyms mean and how to calculate them. So that's what I'm going to talk about today. But at the end, I'm going to talk about a methodology that I think gets across the information in a much more effective way. Welcome to Feel the Boot, the science of startups. I'm your host, Lance Cottrell, and I'm here to help you navigate that nearly vertical learning curve that you're going to encounter as you're building your business. I know what it's like. I've been there myself, and I've helped countless other founders along their journey. This episode is part of an entire series on fundraising, and I'll put up a card where you can find that and a link down in the description. You can also get all of the content from Feel the Boot both as videos on YouTube, but also as podcasts and as blogs. And again, link in the card and in the description. Angel investors and venture capitalists focus on market size because they need to be able to see large exits. The entire portfolio model they're working with depends on every company having the potential to have a gigantic IPO or acquisition at the end of the day. And I did an entire episode on exactly why that's true, but fundamentally, they need you to be able to make at least $100 million in recurring annual revenue. That's the kind of minimum threshold to look like an interesting company to early stage investors. So that implies that the market's got to be pretty big. If you're in a $50 million market and we need you to make $100 million, well, that's never going to happen. There's no way in the world you can do that. If, say, you do the calculations and your market is maybe a $200 million market, well, now you can do it, right? It is big enough that you could achieve that, but you need to be taking at least half of the entire market. So you'll need to be able to convince us that that is a plausible outcome. If you're in a $20 billion or $100 billion marketplace, now it's a very different equation. There's no question that it's possible to get big enough to take that kind of revenue. The question is, are you good enough to take it from all the other companies that you're going to be competing with? Let's start with some definitions. TAM, SAM, SOM. What do they mean? They're all acronyms. TAM means total addressable market or total available market, and that is the entire market for the thing you're selling. If every conceivable person who could use the thing you're selling bought it, this is how much that would be. Realistically, there's no way any company gets 100% of the TAM. There's always some restrictions. And so there's the second category, the SAM, or Serviceable Available Market or Serviceable Addressable Market. This is the part of the market that has a reasonable need for the product that you're providing. It's going to be not everyone, maybe it's geographically restricted, maybe there are certain kinds of features that you just don't support. So this is the people who might realistically buy it. Then there's the SOM, the Serviceable Obtainable Market. How many people can you actually get to and potentially get to buy your product? If switching costs are high, maybe existing customers really aren't viable to try to bring into your marketplace. So we're only here looking at the people who realistically you could sell to. These are your likely buyers. And frankly, this is, in general, what people end up paying attention to. In your pitch deck, make sure that your SOM and your financial projections are in alignment. In particular, your projected revenues should never be larger than your SOM. If they are, you've done your SOM wrong. That is the largest amount that you're likely to sell to, so your projections need to be that or lower. There's a few mistakes I see over and over when people are presenting their market size to me. The most common is misunderstanding what their market is. So they'll come out and say, we're in the auto industry, we're making windshield wipers, and the automobile industry is this multi-trillion-dollar industry. That's great. It is a huge market. But you're not selling everything in the automobile industry. Frankly, even the car makers aren't the entire automobile industry. But you are just selling windshield wipers. So that's all you can talk about. Your market is the market for windshield wipers, and particularly the kind of windshield wipers that you're selling, maybe aftermarket windshield wipers or OEM windshield wipers, right? Be specific. I need to believe that you can, in fact, make the money that you're quoting in your SOM. Another common mistake is including money that you don't get to keep. So particularly in situations where you have a pass-through business model, you're handling transactions for other people, there's a tendency to want to quote the gross transaction value for your SOM, because that's a nice big number. But if you're only taking 1% of that, then that really isn't your SOM. Your SOM is 1% of the total transaction volume that you're going to be processing, not the whole thing. Because what I care about as an investor is what ends up in your pocket, not the total amount of money that flowed across the countertop. So let's walk through a hypothetical example, and I think when you see how this works out, you'll understand why I'm a little bit dubious about the TAM SAM SOM model. So let's imagine that I have founded the Acme clothing company, and we make indestructible clothing. We were inspired by Wile E. Coyote, and we know that we need to have things that are going to last through all sorts of problems. So the first thing I might do is say, what's the TAM? What's the total available market? Well, everyone needs clothing, and certainly indestructible clothes would be nice. So perhaps the entire clothing market is my TAM, right? Absolutely everything. So that's $1.6 trillion. It's a big market, but obviously not everyone is going to buy fancy indestructible clothes. So we're going to take it and break that down. So who actually needs this? So let's say I'm a US company and my marketing is going to be in English. I'm only going to target the North American market for my indestructible clothes, at least for the foreseeable future. So let's say my SAM then is just the US slice of that. And so that looks like it comes out to about $360 billion. So we'll say our SAM is $360 billion. So then what's our SOM? Well, only 40% of people work in physically demanding jobs. So we might say people who have desk jobs, I mean, they might like to have indestructible clothing, but they probably don't really need it. So only 40% of the SAM are likely buyers. And so we'll define that as our actual market opportunity. So that's what, $144 billion. That's where we end up with, that's what I'm going to quote. Now that all feels pretty arbitrary, right? Why do those people want to buy it? Have I done any testing? Have I measured it? Do I have data that shows that there's that many people who want to buy the kind of products I'm selling? And this is a classic top-down type of model where I'm starting with the biggest top line number that I can find, and I'm just trying to subtract out the parts that I think I'm not going to get. And the problem is it's easy to miss those. It's very wishy-washy on how you pick those numbers and why you set the fraction that you think you're likely to get in the first place. I mean, I'll often see people saying, well, the market's this, and we think we can take 5% of that. To which I always say, why 5%? Why not 25% or 0.5%? Those all seem equally reasonable, arbitrary numbers to pull out of your hat. So I want to really see this thing supported. And that's the key. There's going to be homework, there's going to be research, you're going to need to go out and get these numbers accurately. The alternative to doing a top-down analysis is doing a bottom-up analysis. So that's where you start by looking at the actual people that you're going to sell to and build up to the dollar volume of sales that you think you can reasonably achieve. So you're going to define who's that target market, understand who the customer is, are they likely to buy it? And you do some testing. You understand what pricing is going to work with that market based on whatever research and experiments that you can do. Now you know that the market opportunity is the number of people that you've identified times the amount that they're willing to pay. And this is one of those cases where you can use a percentage. So if this is a market where there's no winner-take-all scenario, there's going to be a lot of players at the end of the day, and there's no likelihood anyone can take a fully dominant position, you can say, we expect to be able to take 20% of the market. But you're not going to do that as an arbitrary number. You're going to do it based on the number of established players and what fraction of the market the dominant players hold in reality. And you're making the claim that you will also become one of those dominant players at the end of the day. That is the one exception to not putting in a percentage of the total market. Now, one place a lot of people seem to get stuck is around trying to get these numbers to do the bottom-up analysis. Where do you find the data that you need to come up with an accurate calculation of your market opportunity? The reality is it's going to take some research. It's not easy. It's a fair amount of work. You can start by looking at industry reports. Has anyone written up their own research on the size of the market you're going after and how it breaks down? So you can segment through that and understand what's the market opportunity in terms of dollars, or how many people there are and what their buying behavior might be. There's often information available. You can also look at some of the information coming out from your competitors. They may, if they're public in their annual reports or other PR materials, talk about the market and the market size and the opportunity. You can use their numbers in your own decks and just cite them. Say, this large competitor who should know what they're talking about says X, Y, and Z about the market opportunity. You also want to be talking to customers. Go out and interview people who might be wanting to buy your product, whether that's in a B2B or B2C scenario. Really dig into, would they buy it? Is it a priority for them to buy it? So even if it's something that they need and it's a price they would pay, if there's 20 other priorities that are higher than you, they're probably never going to get around to implementing your product. You want to make sure that you're getting that kind of information to help you size out the marketplace. How often do they buy? What kind of decision-making process do they go through? And you can be doing this in interviews or indeed in surveys. Lots of ways of trying to get at this information to allow you to get accurate enough data to go out there. We all know it's not going to be perfect. This is a best efforts kind of process. But if you've done the homework and you can show your work, investors will be impressed with the results. Whereas if it looks like you've just made up all the numbers, we're going to be extremely dubious about both your market as quoted and you. When you're showing your market size, the key number is in dollars. It's currency. How much money are you getting? Show me the money! It's interesting to see the number of people, but I'll often see decks where the TAM, SAM, and SOM are shown specifically in the number of people. And that's interesting, and you can show that when you're showing your work. But what I care about is the dollars. Make sure you're showing them. And this needs to be in annualized dollars. So this is another thing that you need to take some real care with, especially if you're not a subscription service. If you're selling some good where people are going to be buying it once or periodically, you can't then take the entire population that might need your service and say that times the price of my product is my annual revenue, so that's my SOM, because not everyone necessarily buys your product every year. If it's a car, for example, it might be every 6 years that they're going to buy it. So in fact, your SOM is a sixth of the price of the car times the number of people who might want to buy your car every 6 years. Or maybe it's something they're buying all the time. It's some replenishable thing. It's a food or a drink, and they're buying it every week. So now it's the number of people who would want to buy it times 52 because they're buying it every single week. And that can give you your annualized revenue. But always be thinking in terms of how much money could you reasonably be getting from this entire population of people each year. So you can probably already see some of the problems with the TAM, SAM, SOM methodology. First off, the definitions are not very clear. It's a little bit murky, and two people with good intentions could come up with very different answers for the TAM, SAM, SOM for the same business. It's fraught with judgment calls about what counts in, what counts out, how do you decide who is really obtainable versus not obtainable. And at the end of the day, as an investor, I really only care about your SOM. I'm not all that interested in the total number of people that you can't sell to. I'm interested in the number of people that you can sell to, the serviceable obtainable market. So that's the one I care about. And all the real estate and time you've taken showing and talking about those other numbers is kind of wasted. So before I move on to what I think you should be using instead, I want to take a quick pause and ask you to do me a favor. Like, subscribe, and ring that bell. You knew that was coming. I also encourage you to go over to feeltheboot.com and sign up for my newsletter. That way you'll be alerted every time new episodes come out, because the algorithms are not always good about showing you that. It'll also give you access to my office hours. So there's 3 ways that you can work with me if you need one-on-one advising, because you've got unique problems that I haven't covered in these videos. Through the newsletter, you get access to my free office hours. You can sign up for 15 minutes to talk with me. I also have paid office hours that have more availability and priority, because I realize my free office hours are starting to book up months in advance. And finally, for companies that I've worked with through one of these other 2 methods over a period of time, and it seems like a good fit, I will come on as a formal advisor for equity. And so once we've had a chance to talk a couple of times, I'd be happy to consider that. One of my frustrations with the TAM SAM SOM methodology is that it's just a snapshot. It just shows you one point in time of what is the total available market. But we know that as a company, you're going to be growing into your marketplace. You're going to start with something small, some local area, you're going to expand, and then you try to take over the entire world. I think it's very helpful to actually represent that when you're talking about your market size. So rather than presenting TAM, SAM, SOM on your slide, I encourage you to look at presenting this more in terms of a timeline. Launch market, expansion market, total market. And you can put some timelines around that. Again, this should all be in dollar terms, and you can show the work a little bit, right? How much would each one of these people be paying, times how many people, times the frequency with which they purchase it, gives you that number. Really just that information, just enough to show the work. I'm not looking for a spreadsheet. I'm not looking for all the inputs. That can go in an appendix slide or be something to discuss in due diligence. But now you're showing how you think about the way the company will grow. In some ways, you're beginning to get into the go-to-market strategy. This could come before or after the go-to-market slide. But here you're showing, we believe we can start off with this low-hanging fruit. Here are the people we can go after right away and get some immediate wins, bring people on board, get the company starting to grow. Here's the middle region. We're going to expand. Maybe you start off with a city and then you're going to expand to 20 other cities. And then finally, you're going to go nationwide or globally. And here's the total market that you can go after there. Again, all of this should be done as a bottom-up basis where you're finding out how many people are in those areas, how many people fit that target buyer profile that are going to be in your marketplace. So it might not be geographic. It might be age brackets or income brackets or certain kinds of parents or demographics, whatever that is. You want to start with something very focused. This is your launch customer. This is the perfect person. If this person isn't buying from you, no one's buying from you. And then you can broaden that out. So again, it's often geographic, but it can be in terms of any kind of customer profile as long as that makes sense and is in fact how you are thinking strategically about growing your business. In addition to just going after larger markets, you may be thinking about expanding your product line. So you're starting out with a single offering and then you're going to start bringing in related products, which means an opportunity to sell more things at a total higher basket value per customer. That can also roll into these three calculations. So phase one, single product. Phase two, we're selling 2 or 3 things per person. Phase three, now we have a whole range of things that we're selling to them. So the revenue per customer goes up in addition to the number of customers. So let's go back to the Acme clothing company. I still want to sell indestructible clothing, but not everyone really needs that. And at the beginning, it's going to be expensive for me to make it. I know my unit costs are going to be very high. So I want to get specific to people who have the budget and need for indestructible clothing. And I'm going to start with superheroes. They absolutely need indestructible clothing because they're punching through buildings and getting hit by all sorts of weapons and whatever's going on. And they either are personal billionaires or something like that, out for vengeance, or they're backed by a government. But in any case, they have the money to do this right. So we might say that there's something like 6,000 of them, and we're going to sell these at $50,000 per suit because these are really expensive bespoke things, but they're willing to pay that. So our initial launch market then is something like $300 million. And that's nice. That's a nice, respectable number. That's actually pretty big. Then to expand out, we're going to say, who might need this next? So maybe we're going to say the next category of people as we're growing might be military and extreme sports people, especially professional extreme sports people. Again, these are groups that have a lot of wear and tear and have budget. But at this point, not really as much budget as the superheroes, but it's a much larger group of people. So when we're going into this expansion phase, we might say something like there's 2 million likely users of our product, and they're going to pay $5,000 a suit because that's now within the reach of even sort of marginal professional athletes who want to have our bespoke super suits. And then finally, we're going to blow this wide open. We're going to bring the price way down and try to hit everyone who might need this. So hazardous workers, or people who are doing manual labor, amateur sports people who put a lot of wear and tear on their clothing. Again, we've radically sized up the number of people who are potentially buying our products, and maybe we're looking at something like 400 million users, and we're going to drop the price even more. And maybe these are a little less indestructible, but they're $500 a suit. Almost anyone could buy a $500 suit, right? That would be great. So maybe this is a $200 billion market. Now, you probably spotted one of the mistakes. If they're indestructible clothing, people aren't buying them every year. So really, I should have done this with a one-time purchase, or maybe I need to rethink my business model and make my clothing a little less indestructible so that they will have to come back maybe on an annual basis to replace the suits. I like this approach because it gives me much more information. I can see your total market, how big is this opportunity at the end of the day, and I also learned something about how you're planning to get there. It can help me understand whether or not your strategy seems plausible or completely fantastical. And you're showing me how you got to those numbers, because you're doing everything in a bottom-up way. It's far more believable. Thanks for watching this episode. I hope you found it useful and interesting, and if so, do the usual: like, subscribe, ring that bell, go over to feeltheboot.com, sign up for the newsletter, get on my office hours. I love talking to founders. You guys have some of the most amazing ideas, and I'm always learning something from you. And it allows me to help you with issues that I really can't cover in episodes like this because they're specific to your business needs. Until next time, ciao.